Most people begin to invest in stocks by reacting to the financial news, considering current financial data, or trading chart patterns. And I wasn't much different. I began my path by immersing myself in learning about fundamental security analysis. After that, I studied technical analysis, which is the assessment of price and volume and chart patterns. I thought having that combination of knowledge, fundamental and technical, was like playing basketball with two hands. But only later did I discover the missing piece, which was trading psychology. The psychology of investing includes recognizing and managing one's self-sabotaging emotions. In hindsight, I should have just flipped the order of my study. Hi, I'm Harry Starn, and welcome to the Starn Standard Practical Financial Knowledge video. In this recording, I want to share 4 emotions that can sabotage your long-term investment returns. Specifically, we'll examine the impact of procrastination, selling winners while keeping losing positions, pursuing the perfect buy and sell, and chasing winners. Awareness of these self-sabotaging habits, what causes them, the damage they do to portfolio returns, and how to manage them is a critical step towards becoming a more informed and smarter investor. Procrastination is simply the tendency to defer to tomorrow what could and probably should be done today. Examples of procrastination include delaying the opening of an individual retirement account, failing to contribute to savings, postponing the process of creating a budget, or delayed thinking about tax planning, maybe until very late in the year. Besides the stress related to money avoidance, there are serious negative financial implications. Failure to open the retirement account and fund it results in lost opportunity. The account misses out on compounding interest. The lack of sufficient savings has a negative impact on the retirement timeline and on your vision for retirement. Avoiding any tax planning until late in the year means the tax bill is going to be higher. Dollars that could have been invested for future benefit are missing. There are several potential root causes driving procrastination. They include the fear of making a mistake, lack of confidence, waiting for just the perfect start time, rationalizing that other things are always more important, daily distractions, and poor accountability. Getting past those obstacles begins with the awareness of that negative financial impact and your commitment to take action. If the action requires a large leap, it's useful to frame the decision into a series of small steps. Setting up automatic contributions from your bank or employer paycheck avoids the necessity for ongoing decisions. Establishing accountability involves setting deadlines and possible consequences for inaction. For example, I recall one advisor saying that if he missed his deadline, then he needed to make a financial donation to somebody he didn't particularly like. Now that would be a motivator, right? Wall Street saying number 1, opportunities are like trains. There's always another one coming, but not if you never get on. Recognizing procrastination and taking steps to address these are a critical step in moving towards financial wellness. A common tendency of investors is to lock in their gains early by selling. It makes you feel good. And after all, you never go broke taking a gain. Well, that's true, but it's only part of the overall picture. Selling the security for a small gain negates the possibility that it could compound into a large gain. The reason the security appreciated in the first place is because the market anticipates strong financial results in the future. You see, the market is a discounting mechanism. Today's price reflects tomorrow's projections. Unfortunately, our purchases don't all result in gains. There's no sure thing because we don't know the future. Another tendency, which is even more self-sabotaging than selling early, is holding on to losing positions. The combination of selling winners early while holding on to the losings for a long period is destructive. There are several reasons why investors tend to hold on to their losing positions. First, it's a form of regret avoidance. If you sell the security at a loss, then there's that negative emotion associated with admitting that maybe it was a poor investment. On the other hand, there's no regret when the person thinks it's only a paper loss, it's going to come back. The hope of the rebound keeps many portfolios mired with losing positions. Other reasons include an emotional attachment to the security, lack of a clear exit discipline, and uncertainty regarding the cause of the decline. Moving beyond the tendency of holding losing positions begins by reframing the loss. Rather than beating yourself up about making a poor investment decision, realize that we invest in a world of total uncertainty. We can't control the markets. We can only control our own actions. Think holistically about the portfolio, not the loss or the gain on any one security, and develop your buy-sell discipline. Did you realize that professional traders always know where they will start taking some profits and where they will stop out of the trade? Selling losing positions also allows you to leverage the tax benefits of tax loss harvesting. Your capital losses offset your capital gain, which means you'll pay less in income taxes. Moreover, the proceeds from the sale can be repositioned in securities with better forward-looking projections. Wall Street saying number 2, cut your losses short, let your winners run. Recognizing the downside of selling winners too soon and holding losers for too long is an important step towards changing behavior. Many investors fall into the trap of chasing the perfect buy or the perfect sell. Who wouldn't like to get the highest price on the sale of an asset or purchase the security at the cheapest price? Unfortunately, I don't think there is a perfect combination. Let me share a quick story. A friend of mine sold his entire portfolio a day or two before the 2000 dot-com high-tech market crash. His timing appealed excellent. I spoke with him a couple years later and asked, when did you reinvest back into the market? He replied, well, I didn't. I'm waiting for the market to go back down to that market low again when I plan to buy. His original sale, combined with his subsequent inaction, resulted in a self-sabotaging trap for his future well-being. There are several factors fueling this emotional tendency, including the desire to be perfect, myopic thinking focused on just today, the fear of having regret about the timing of the buy or the sell order, the belief that the person will be able to recognize when the time is exactly right. Seeking the perfect buy and sell has negative consequences, including stress, sitting in cash for too long, and the tax consequence associated with high portfolio turnover. One way to avoid the trap is through dollar cost averaging your investments. This means investing a set amount systematically. For example, at the end of each month, at the end of each quarter, regardless of the market situation. Now, if you have a lump sum and you're worried about the timing of the purchase, then you might invest a third now, a third in a couple months, and the remainder a few months later. Additionally, adopting the supportive long-term mindset of it's about time in the market, not timing the market, will help you move beyond the need for perfection. Wall Street saying number 3, the perfect trade only exists in hindsight. Pursuing the perfect buy or sell can trap investors in indecision. However, recognizing the emotion And adopting a systematic approach to buying and selling can help you avoid the perfect timing trap. Herding is the tendency to follow the crowd instead of thinking and making decisions for yourself. There's a sense of safety and commonality when everybody's moving in the same direction, when you're joining that momentum. Unfortunately, that usually ends badly for investors. You see, for security prices to go up in price, there needs to be a lot of buying because you already know that investors tend to sell their profitable positions. For the security to increase in value, there needs to be more people wanting to buy than wanting to sell. In contrast, there only needs to be one person who wants to sell and nobody who wants to buy for that price to drop like a rock. There are numerous reasons contributing to the tendency of chasing winners. These include the fear of missing out, the emotional comfort of being part of the crowd, and rationalizing a valuation simply by extrapolating the current numbers into the future. The negative consequences of chasing winners include stress, the accumulation of a concentrated portfolio perhaps, and that represents significant portfolio risk, greater portfolio volatility, and potential regret. Avoiding the trap of continually chasing winners begins by realizing that long-term investing success comes from patience and a solid investment game plan. You need to determine what asset allocation is right for you. How will you select securities? How will you diversify the portfolio? And what percentage of the portfolio can be held in any one security? While momentum investing might be part of your strategy, it needs to be moderated with prudent exit strategies. Wall Street sayings number 4 and 5. The trend is your friend until it ends. And trees don't grow to the sky. Chasing stock winners will feel tempting, but understanding why the public does this, the risk it creates for your portfolio, and how staying disciplined can help avoid costly portfolio mistakes will improve your long-term results. Benjamin Graham, who is considered the father of value investing, was quoted as saying, "Investing isn't about beating others in their game. It's about controlling yourself at your game." Controlling yourself at your game has a lot to do with managing self-sabotaging emotions. In this video, you learned about 4 emotions that can negatively impact your long-term investment returns, including procrastination, selling winners while holding losers, obsession with the perfect time to buy or sell, and chasing winners. Awareness of these emotions and an understanding of how they influence your behaviors are important elements of successful investing. Well, thank you for watching this practical financial knowledge Star Standard video. I invite you to watch other Star Standard videos that I've posted on investment planning or other relevant pieces of your financial planning puzzle. If you found the video content useful, then please tap the like button and consider subscribing to the Star Standard channel. Have a great day and hope to see you in another video.